Hey, welcome back to the What the Wealthy Do podcast. This is a podcast where we break down the money moves that the wealthy use and show you how you can apply those same strategies on your everyday personal wealth building journey. I am your host, Stephanie Dorsey. I am the CEO and co-founder of Margins Capital. Margins Capital is an investment firm focused on providing women and people of color access to an institutional quality portfolio of alternative investments. That is right, you invest with margins. You get access to the things that we've been talking about in our alternative investment series. We've already hit on private equity, venture capital, commercial real estate, and today we're going to talk about one of the most mysterious and misunderstood investment vehicles out there, the hedge fund. Yes, you've heard it right. You've heard that term thrown around in movies, on the news, maybe even in conversations with your wealthy friends. But what actually is a hedge fund, and how do they work, and why are they the playground of so many ultra high net worth individuals, or the playgrounds of billionaires, pension funds, and institutional investors? We are going to break all of that down today. But more importantly, should you even care about hedge funds if you're not managing $100 million portfolio? And the short answer is yeah, you should, because understanding hedge funds will help you understand how the wealthy think about risk, returns, and portfolio construction. And it will also help you understand what is happening in the market and why investors making certain moves that they're making. And even if you never invest in a hedge fund directly, knowing how they operate gives you insight into what's happening in the markets. And so before we get into it, you know the drill. This podcast provides financial education, not financial advice. All right, so let's start with the basics. A hedge fund is a private investment fund that pools money from wealthy individuals and institutional investors to pursue aggressive, sophisticated investment strategies. What does that mean? Unlike mutual funds, which are heavily regulated and are available to anyone, regardless if you're an accredited investor or not, hedge funds operate with much less regulation. However, you have to be an accredited investor in order to invest in one. And just to remind you, an accredited investor is an individual that has earned $200,000 a year for the previous 2 years, or if they're married, collectively earn $300,000 for the previous 2 years, or you have a net worth of $1 million or more that does not include your primary residence. So you can't include the equity that you have in your house as a part of the calculation of your net worth. So the original idea behind hedge funds was right there in the name. It's to hedge against risk. And the very first hedge fund was created in 1949 by Alfred Winslow Jones. He used a strategy of buying stocks he thought would go up, that means going long, and selling stocks he thought would go down, going short. And that way, whether the market went up or down, he could still make money. But over time, hedge funds, they evolved. Now they're less about hedging and more about absolute returns, meaning they try to make money in any market condition, bull or bear. So whether people are in the bear market and not want to invest, or in the bull market and they're like, invest, they're trying to make money, and they're saying that they can make money, and they charge a premium for it. And so we're talking about the famous 2 and 20 free structure. That's 2% of assets under management every year. So if they manage $100, they're going to take $2 every year. And then they're going to take 20% of any profits. So that's a performance fee. And this fee structure is frankly how hedge fund managers become billionaires. And if you all listen to the episode where Erin Harkless Moore, I interviewed her from Pivotal Ventures, and there's a saying like, returns are not guaranteed, but fees are absolutely guaranteed. All right, so how are hedge funds different from mutual funds? And so let's break that down. So a mutual fund is they pool money from a whole bunch of investors and is actively managed by a fund manager or managers, a team of managers. And they invest in different stocks and bonds and or money market accounts. It's relatively straightforward. I mean, they will have their own investment strategies, but it's pretty straightforward as opposed to a hedge fund, which will have a little bit more complex investment strategies. Another difference, though, is, we talked about whether or not you had to be an accredited investor to be in a mutual fund, which you do not. And so mutual funds are for the masses, right? Where hedge funds are for wealthy and institutional players. But here's the thing, hedge funds can do that mutual funds cannot. They can bet against stocks, and they use massive amounts of borrowed money, leverage. They trade also commodities and currencies and derivatives, which is an umbrella term that means a contract between two or more parties where value is derived from the performance of an underlying entity. So like when they short a stock, when they bet that the stock will go down, or they long a stock when they bet that the stock will go up. The underlying asset is the stock, but the contract is between one or more parties. And so that's why it's called a derivative. And they employ different strategies designed to make money, whether the stock is going up, down, or sideways. And that flexibility is what the wealthy pay for. So, okay, let's talk about how they actually make money. Because it's not just buy stocks and hope they go up, right? These are the primary strategies. Obviously, they could be a combination or even probably more complex, but these are the primary ones that you should be aware of. So there's the long and short equity. And like I was talking about that, a fund buys stocks that they think will go up, they go long on it, and they buy shorts on stocks that they think they will go down. We're not going to talk about puts and calls and things of that nature. You don't need to know that. You just need to know this is essentially what they're thinking about. And if they're right on both sides, they make money no matter what the overall market does. And so anyone who is watching the show Industry on HBO should recognize the short that Harper Stern put on the business Tinder in season 4. Like that was kind of the main theme of season 4. It was very good. I just finished watching it. So that's what the long short equity play is. Then there's the global macro play. And these funds, they make big bets on global economic trends like interest rates, currencies, commodities, geopolitical events like what just happened in Iran. And they might bet that the dollar will strengthen, or that oil prices will crash, or that a country's bond market will collapse. I don't know if you all are aware, but like on Polymarket, there were people that placed bets. I think this one investor turned $87,000 into $515,000 based on the Iran bombings. And so, yeah, I think that is a little different. That is not hedge fund. I would not put that in, because that was clearly probably insider trading, but you get the gist.
Hey, it's Stephanie. If you've been listening to this podcast for a while, I talk a lot about how the wealthy think about money differently. And one of the biggest differences is how they approach taxes. Most high earners wait until April, file their taxes, and hope for the best. Wealthy people, they plan the October before. They design their income, assets, and giving around the tax code. And the gap between those two different approaches, tens of thousands or hundreds of thousands of dollars every year. That's why I created the High Earner Tax Playbook. It's a course that breaks down the exact strategies wealthy people use to legally pay less, from maxing corporate benefits the right way, to side hustle or business deductions, donor advised funds, tax loss harvesting, and advanced strategies like QSBS for investors and mega backdoor Roth. This is not tax advice. This is tax education. So you can walk into your CPA meeting informed, confident, and strategic. If you are tired of overpaying out of ignorance, check it out. Link is in the show notes below. Now, let's get back to the show.
Then there are event-driven hedge funds or investment strategies. These funds capitalize on events like mergers and acquisitions, bankruptcies, or restructurings. For example, if company A is buying company B, like Paramount is attempting to buy Warner Brothers, an event strategy might be company B's stock or Warner Brothers stock will increase or decrease, and someone might short or long it based on what they think will happen as a result of that purchase. Quantitative or quant funds, these are run by mathematicians and computer scientists who use algorithms and data models and high frequency trading to find patterns and execute trades faster than humans ever could. If you think about the TV show Billions, Taylor Mason left Axe Capital to start a quant fund because they really kind of believed in quant being a little cleaner because Axe Capital was old school in terms of influencing the market. And even if you don't want to go with, we want to go to real life, but Ray Dalio's fund is a quant-based fund, and he uses a lot of analytics to look at what has historically happened in the markets to try to predict what will happen in the market. So, all right, another strategy is relative value or arbitrage. And so these funds look for pricing inefficiencies between two securities. For example, if two bonds should be priced similarly, but they aren't, they'll buy the undervalued one and short the overvalued one, profiting when the prices converge. I love arbitrage. And I think that we should always be looking for arbitrage opportunities in our daily lives. I was fortunate enough to refinance my house in 2021. So I have a 3% interest rate. This is not exactly arbitrage, but it's looking at the relative value between what you can do with your money. Like, I like to think about, instead of, I can pay off my loan, or I could pay down my mortgage faster, or I could pay down my student loans faster because I was able to refinance those as well and get 3%, or I can invest it in thing A. And if I'm going to get 10% from putting my money over there, then a 7 percentage point delta between putting my money to work in this investment versus paying down a loan. And so that's how I often am thinking about arbitraging my money that way. And it's technically not arbitrage, it's technically just trade-offs. But like, I just had to highlight that. Always think about the trade-offs of your money. Always think about that. So back to our regularly scheduled programming. Okay, and then the last investment strategy would be distressed debt. And so these funds buy the debt of a struggling or bankrupt companies at a discount, betting that they can recover more than what they pay for when the company restructures or liquidates. So yeah, hedge funds aren't just picking stocks like mutual funds are. They're running very sophisticated, multi-layered strategies in order to make money, obviously, but these are strategies that most individual investors don't have access to or the expertise to execute. So why do the ultra wealthy and institutional investors pour billions of dollars into hedge funds? It's because of the absolute returns, right? Hedge funds aim to make money regardless of market direction. So in 2008, when the S&P crashed 37%, some hedge funds made money. And that's the promise, right? The positive returns, even if everything else goes to, like, you invest in hedge funds so that you can offset that. Another reason why the ultra wealthy love hedge funds is because of diversification. Hedge funds use strategies that aren't correlated with traditional stocks and bonds. And so they can smooth out portfolio volatility. And when your stock portfolio is down 20%, your hedge fund might be up 5%. And that balance matters. It's access to top talent, right? So hedge fund managers are some of the smartest, most sophisticated investors in the world. You're paying them for their expertise, for their research teams, and proprietary strategies, and also downside protection. Good hedge funds are designed to limit losses. So they use hedging strategies, options, risk management to protect capital during market crashes. And then again, let's be real. Exclusivity and prestige. I mean, there's the status element. Investing with Bridgewater or Renaissance or Citadel is like being in an exclusive club, and it signals that you're playing at a different level, and they care about that. I don't know. But here's the catch. Like, not all hedge funds live up to the hype. Most don't. So let's talk about like the dark side of hedge funds. So number one, they have high fees, and those fees eat into returns. I mean, that 2 and 20 fee structure can be brutal. And let's just say a hedge fund makes 10% in a year. After the 2% management fee and 20% performance fee, your net return might be somewhere around 6.4%. Meanwhile, the S&P 500 might have returned 10% with way lower fees. And so over decades, those fees compound and can cost you millions of dollars. Number two, many hedge funds underperform the S&P 500 over the last 10 to 15 years. In fact, Warren Buffett famously won a bet in 2017 proving that a simple index fund strategy outperformed a basket of hedge funds over 10 years. And so you're paying premium fees for mediocre return in many cases. It's just, I don't make recommendations, but I do agree with Warren Buffett in this case. Like, it probably makes more sense depending on your goals to invest in an index fund over a hedge fund. Also, the lack of transparency. Hedge funds, they don't have to disclose their holdings or their strategies. And so you're trusting the manager blindly. And if they're taking excessive risks or making bad bets, you might not know until it's way, way, way too late. Also, there are illiquidity and lockup period risks. I mean, your money can be locked up for 1 to 3 years. And even after that, you might only be able to withdraw quarterly or annually. If you need that cash, tough luck. Yeah. Not great, not great. Another issue is that hedge funds have blown up spectacularly. Like long-term capital management nearly collapsed the global financial system in 1998. And Bernie Madoff ran a fake hedge fund that turned out to be a complete Ponzi scheme. And so the risk is absolutely real. They also have really, really high minimums. I mean, most hedge funds require $1 million to $5 million to invest with them, partially because they need the scale in order for their strategies to make the return. But that investment minimum keeps out like 99% of the population. And again, I have to agree with Warren Buffett, like you're not missing much. But hedge funds, they are powerful. They're not for everybody. And they're definitely not a guaranteed win unless you're the hedge fund manager. So should you care about them? You absolutely should. And I'm going to tell you why. You don't need to invest in a hedge fund directly, but understanding how they work helps you become a better investor. I mean, it teaches you about risk management, portfolio diversification, alternative strategies beyond buying and holding stocks, and how to make money in different market environments. Like there are a lot of regular individual retail investors that are learning things about options investing and things like that. And I don't think that that's necessarily a bad thing if that's something you're interested in. The wealthy, they're using hedge funds as a piece of a much larger puzzle. They're not putting all of their eggs or all of their capital or money into hedge funds. They're using them strategically to reduce risk and capture uncorrelated returns and access to top tier talent. So it's fine. And that's basically the mindset you should adopt as well. Diversification strategy and thinking beyond the stock market. And again, getting access to people who are thinking about these things, especially if that's something that you're particularly interested in. And so here's what you need to take away from today's conversation is that hedge funds are out here and they are a sophisticated tool that the wealthy are using in their toolkit. And they are designed to make money in any market and to protect downside risk and provide access to strategies that most people can't execute on their own. But that doesn't mean that you can't start to think about these similar things and employing these similar strategies in managing your portfolio as well, right? So the real lesson here is we're doing what the wealthy do in terms of adding diversification, right? Thinking about what type of investments we can invest in to mitigate downside risk. And we're getting access to top tier talent so that we can make sure that we are thinking about things that we might have missed otherwise. And that's the key takeaway in terms of learning about hedge funds and what from hedge funds that we can start to adopt on our wealth building journey. All right, y'all, that is today's episode of What the Wealthy Do, where we talked about hedge funds. We still got a couple more asset classes left in our alternative investment series for this month. So if you found this episode to be helpful, and if you liked it, please share it with a friend. Don't forget to like, comment, and subscribe wherever you like to get your podcast. We're on Apple, Spotify, and YouTube, and we will see you next week. Bye.